Using an evidence-based approach to investing is a lot like using modern medicine. Just like physicians have to have an empirical evidence to their prescribed paths, when we look at the evidence-based approach to investment, we've got to look back at history and say, okay, we're learning some things here and we're trying to take those learnings and build a portfolio. Just like physicians are no longer prescribing leeches and bloodletting for all kinds of different maladies like they were a couple hundred years ago, we want to look at the evidence that we have and try to construct a portfolio that makes sense given what we've seen.
Today, we're going to be talking a little bit deeper about the performance of the factors that we talked about in a previous video. Just as a reminder and some disclosures here, we're going to be looking at size, value, and profitability. If you don't remember what we're talking about, feel free to go back to the last episode and watch that. And we're also going to be looking at past performance. That doesn't guarantee any future results. Just like a doctor might prescribe statins, it may not treat that illness. Past performance doesn't guarantee anything in the future. So Spencer, as we look at these factors and the tilts of the portfolio that we talked about in that previous episode, what are some things that we need to know just in general about when we look at performance of this?
One of the things that we want to remind ourselves is that we don't want to just focus on one factor or another. You hit three of them, and the way that we want to look at this is kind of trying to bring them all together, because we know that there's going to be some seasons when any one of them is not going to perform all that well. So as we build a portfolio, we want to recognize that there's going to be periods, again, where those factors don't show up or where the premium would be negative. It would not be in our favor there. And so we want to frame this kind of as like there's a six-sided die that we're rolling. If we had that dice and we had an opportunity to roll it one time, and I posed you, and let's just say you're getting close to retirement, you've saved a lifetime, and if you roll a 1, 2, 3, or 4, then your money doubles.
I like it.
Yeah, but if you roll a 5 or 6, all that money goes away.
I don't like it.
You lose everything. Most folks, as they approach retirement, they're not going to take that gamble, because even though on average you're going to do well there, you're going to have far too much risk in terms of being exposed. Now, if I then said, well, now you've got 10 rolls of the dice and you only have to get 5 of them as a 1, 2, 3, or 4, that's stacking the odds in your favor, again, because we've got more rolls. In the same way, if we can have more time, instead of looking at 1 year, say for our factors, we think about 10 years, then we're able to stack the odds a bit more in our favor. So again, if you only have to roll a 1, 2, 3, or 4 5 times out of 10, then your probability increases to 92% that your money's going to double, and still 8% that you lose everything. That may still not be an acceptable risk.
Yeah.
You've worked again a lifetime for these funds, so you may say too much risk still there. Well, what if we looked at it and we said you get 100 rolls of the dice and you only have to get 50 as a 1, 2, 3, or 4? Now we look at a percentage that's something like 99.98%, I think, there. So an incredibly high percentage, and that may incline you again to move in that direction to take the gamble, because again the odds are stacked in your favor. We don't believe that we can ever completely guarantee that we're going to stack the odds in a client's favor to a point where they're going to be certain of that benefit. But what we do want to do is progressively move things in a direction where we are stacking the odds in their favor without taking on a tremendous amount more risk in the process. That's why we want to blend these factors: size, value, profitability, because we know that there's a high likelihood that at some point in time one of those factors is not going to show up in a particular year. And we'll go through what we've seen over the last many decades, but also over the last decade, which has shown that the value premium has actually been negative over the last 10 years in the US and also around the world.
So let's go ahead and look into some of these historical premiums. And really, we want to look over, just like you were saying, it's not just a 1 year. We're going to look 5 years and 10 years down the line. So we're going to pull up a slide. It's the historical performance of premiums over these rolling periods. So think about Tuesday, April 19th of 2023 to Tuesday, April 19th of 2024. This data is going to come from Dimensional Fund Advisors and the research that they have done. So let's just go ahead and start off with the market against T-bills. So again, T-bills are those really short time frame government issuances. In a 1 year period, 70% of the time, the stock market beat T-bills.
Right.
That's a pretty good odd.
Yeah, and it's U.S. stocks here against Treasury bills, so 30-day bonds, essentially, or bills that are issued by the U.S. government. This would be in financial planning or investment textbooks. This would be known as the risk-free rate of return.
Yep.
So guaranteed by the full faith and credit of the U.S. government versus the stock market.
Yeah.
Over a 1 year basis, we look back to the 1920s, and 70% of the time, like you said, Austin, we see U.S. stock market beating Treasury bills.
Yeah. Which, you think about it and you're like, that makes sense. The U.S. stock market should do that. But again, over those 1 year rolling periods, sometimes T-bills do better. If the stock market is down for an extended period of time, then T-bills are going to be better for you. But again, if we extend that out to a 5 year time frame, again, those rolling 5 year times, 79% of the time, the stock market does better. You stretch it out further, 10 year time frame, 86% of the time, the market does better than the T-bills.
Right.
So again, it's kind of like we're rolling the dice 100 times versus rolling the dice 6 times.
Right. Well, and when we look at that 10 year period, it really is kind of 1 in 6, that is, or 1 in 7 periods where we see T-bills outperforming the market. And we've seen that in the last 20 years.
Yeah.
If you think about where the stock market was at the technology bubble peak in 2000, we had a big drop thereafter. We saw a recovery and press into new all-time highs, but then we saw the global financial crisis. So from 2010, or 2000, I should say, to 2010, many of those periods in there, if we just look at that 10-year time frame, indeed, T-bills outperformed the U.S. stock market. But most of the time, that's not going to be true.
Right.
We do have to recognize, though, that that is one of the pieces that can occur.
Yeah. So let's now take a look at value versus growth. Again, if you don't remember what value and growth are, you can take a look back at that last video that we did. But again, that 1 year time frame, 60% of the time, value beats growth. That's a pretty decent odd. You stretch it out 5 years, it's 70%. 10 years, we get to 79%. Again, there's going to be periods where it doesn't outperform growth.
Right.
But over the last 100 years or so, it's done pretty well. Value has done pretty well.
Yeah, and one of those 10-year periods has been the last 10 years. So we want to be open with that. There are 10-year periods where that doesn't work out. But about 4 out of 5 times, if we're rounding there, it does work in our favor.
So let's look at small versus large. And again, the story remains the same. 1 year, there's a much tighter window. 56% of the time, small cap stocks do better than large cap. In a 5 year time frame, 60%. In a 10-year time frame, 69%.
Right. So again, this is just historical. We're not saying going forward that this is going to be the case, but if we look at 10-year periods, more than 2/3 of the time, looking back at the last 100 years or so, we see that small companies have outperformed their large counterparts.
Yeah. Finally, let's look at high versus low profitability. And again, the story remains true. High profitability companies beat low profitability. In that 1 year, 66% of the time, 5 year, 82%, and then in the 10 year, 92% of the time. High profitability companies regularly outperform their low profitability counterparts.
And we do want to just acknowledge, we don't go all the way back to the 1920s on this data sequence. There were disclosures that started to be made, I think, in the 1960s that allowed the research here. So we can only go back about 60 years rather than close to 100 years in terms of the research here. But you can see high profitability beating low profitability has been very, very consistent when we look at a 10-year basis, about 92% of the time. So again, not every time, but about 9 out of 10 times when we look at those 10-year sequences.
Right. And I think this is where we come back and say, as we're constructing portfolios, we're not just looking at one factor, nor are we saying we're going to put everything in small caps, or everything in value companies, or everything in high profitability. We're going to take a broad look at the market, but just shade that portfolio a little bit towards small, a little bit more towards value than maybe a traditional index that follows the S&P 500.
Sure. And as we think about that, as companies move around there, they become more or less attractive based on their characteristics of value, size, and profitability. So firms oftentimes over the course of a year will be more attractive at one point, less attractive at one point, and that again gives us the opportunity to align accordingly.
All right, so Spencer, we want to take a look now at these premiums across different geographies. So it's not just the US that we see these premiums popping up, it's in the emerging markets, it's in the developed markets. So as we look at this slide, what we want to show is really just that you can see, yes, we don't have data going back as far for the developed markets or for emerging markets, but you can see that small companies outperform their large counterparts across the US, the developed markets, and the emerging. Again, this is historical, so it's not looking forward, but it's saying what has the past shown us. We look at value minus growth. Value has outperformed growth in the US, in the developed markets, in the emerging markets, and as well, profitability. High profitability companies across all three planes, the US, international, and emerging markets, have outperformed over time. But again, that's not always the case. So let's take a look at the last 10 years.
And as we think about the last 10 years, we have seen of those 9 areas, 5 of them show up and 4 of them not. And value has been negative over that time. So going through that again, the last 10 years as we think about 2013 through 2022, we look at company size. And in the US, large companies have actually beaten their small counterparts by about 1.8% on average. If we look overseas though, in the developed world, those smaller companies have outpaced their large counterparts by about 1.2% on average, and then in the emerging markets even more so, about 2.4%. Now across the board, when we look at value, again, relative price, we see that value has underperformed growth in the last 10 years. And I think if we go back to that former slide and thought process, about 1 in 5 10-year periods, you're going to see value underperform growth if we go back many, many years, going back into the 1920s in the US. And it'd be similar if we looked at those time periods in the developed world and the emerging markets, but in the last 10 years, again, it's shown up. So value has underperformed growth by about 1.75% in the last 10 years. Value has underperformed growth by a smaller margin in the developed world, that would be international outside of the emerging markets, again by about 0.7%, and then just barely underperformed in the emerging markets by about 0.06%. If we shift over to profitability though, you can see it's really been a banner season there for US stocks, high profitability versus their low profitability counterparts, over 5% in terms of that difference. We look at that in the developed world and the emerging markets, not quite as much, a little bit over 2% in each one of those different areas. So that's why we look at these. We know that there's going to be periods where these factors don't show up or when they're negative. But we also think as we look back at history, an evidence-based approach would learn from these pieces and then use that in terms of portfolio construction. As we do this, we want to remind you that past performance does not guarantee any level of future results. We try to learn from history, but we acknowledge that the future may be quite different. So it's important as you work to build a portfolio that you talk with your financial advisor, you reflect on these things, and not take this as prescriptive in your particular case. With that, hope that you've enjoyed this video. Take care.
If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.